You've probably seen the ads, the YouTube videos, and maybe even heard of it from a friend. Use a whole life policy to become your own bank. Access your money tax-free. Build wealth like the wealthy do. It sounds brilliant on the surface, and in some cases, it can be. But here's what they don't tell you. For most Canadians, infinite banking is oversold, misunderstood, and in some cases, completely unnecessary. It's not magic, it's not free money, and it's definitely not a strategy you should jump into just because someone pitched it to you on how the wealthy do it. There's real risk in getting this wrong. Today, I want to break down the problems with infinite banking, especially as it's marketed in Canada, and walk through the questions I ask any client considering this strategy before they ever sign on the dotted line. Hi. If you're new here, my name is Darcy Bell, and I'm a certified financial planner professional with IG Wealth Management. I work with Canadians across the country to help them grow, protect, and convert their wealth into tax-efficient retirement income, and avoid strategies that sound good on paper but don't hold up in real life. If you're serious about making smarter financial decisions, make sure to like this video, subscribe to the channel, and leave a comment if you've ever been pitched infinite banking. Let's talk about what you really need to know before considering infinite banking. Part 1, what infinite banking actually is without the hype. Let's start by stripping away the buzzwords. Infinite banking is a strategy where you use whole life insurance policy to build cash value over time. Then borrow against that cash value to fund major purchases, investments, or even retirement. The pitch goes something like this. You can become your own bank. Borrow from yourself, pay yourself back with interest, and your money keeps growing uninterrupted. And on the surface, it sounds pretty compelling. Tax-sheltered growth, access to capital without liquidating investments, guaranteed returns through policy dividends, and the ability to leave a tax-free death benefit to your heirs. But here's what they often don't tell you up front, or what gets buried under fancy terms and cherry-picked charts. 1, you're not really borrowing from yourself. You're borrowing from the insurance company, using your policy as collateral, and you're paying them interest, not paying yourself back. This isn't free money. If you take out a policy loan and don't repay it, it reduces your death benefit. And if unmanaged, the loan interest can compound and eat into your cash value. 2, whole life insurance is expensive and slow to grow. These policies come with high premium, often thousands of dollars a month if you're trying to build meaningful cash value. And in the early years, most of your payment goes toward fees and insurance costs, not investment growth. It can take 10 years or more just to break even. So if you're not prepared for the long game, or if your financial situation changes and you can't keep up with premiums, it can backfire. Number 3, not all policies are equal, and not all advisors are objective. This is critical. Many advisors promote infinite banking are insurance licensed, not full financial planners. That means they may not be comparing it to other strategies like TFSAs, RRSPs, or non-registered portfolios. And in some cases, commissions from selling a whole life policy can be significant, which may influence the recommendation. You deserve advice that's independent, objective, and aligned with your full financial picture, not just what fits a product pitch. Part 2, where infinite banking can work and where it usually doesn't now. The idea behind infinite banking isn't inherently bad. In fact, in very specific circumstances, it can actually be a helpful strategy. But here's the key. It works best for the right person with the right income and the right financial plan already in place. Let's talk about where it can work. 1, high net worth individuals with maxed out TFSAs and RRSPs. If you've already used every tax advantaged account available to you and you're still sitting on surplus cash each year, if so, a participating whole life policy might help with tax sheltered growth, wealth transfer to the next generation, asset diversification outside of traditional markets. But again, this only applies after your basic retirement savings and liquidity needs are fully covered. 2. Business owners with corporate cash. For business owners, corporate-owned life insurance can sometimes be used as a long-term planning tool. It provides tax-sheltered growth inside the corporation. It can fund buy-sell agreements, key person insurance, or estate equalization. On death, it can pass tax-free through the capital dividend account, or CDA. However, this isn't the same as infinite banking as it's pitched online. It's a corporate estate planning tool and should be analyzed alongside other investment options inside the corporation. Number 3, intergenerational wealth transfer. In some cases, families with multi-generational wealth goals may use whole life insurance as a tool for locking in a guaranteed death benefit, funding future inheritance equalization, providing liquidity at death to cover taxes or preserve assets. But again, this assumes your retirement is already funded, your debt is managed, and you're in a strong financial position. Where it usually doesn't work, for young families with limited cash flow. If you're still building an emergency fund, saving for a down payment, or contributing to your TFSA and RRSP, whole life insurance shouldn't be a priority. Those early policy years are front-loaded with fees and insurance costs. You could be better off using low-fee investments that compound faster and give you real liquidity when you need it. For people looking for a quick way to access capital, yes, policy loans are available, but they're not free money. If you need flexible access to cash, a home equity line of credit or HELOC, TFSA, or non-registered portfolio may offer more efficient ways to get liquidity without locking yourself into a lifelong contract. If you're being pitched without a full plan, if an advisor is recommending infinite banking as a standalone solution without a full financial plan, tax analysis, and retirement projection, that's a red flag. Whole life insurance is just one tool, and without the full picture, it can easily be the wrong one. What to ask before you buy or sign anything? Here are the critical questions to ask before you make any commitments. This isn't just about being cautious. It's making sure this fits your situation, not someone else's sales quota. 1. Have I maxed out my TFSA and RRSP first? This is non-negotiable. If you haven't fully used your TFSA, and to a lesser extent your RRSP, two of the most powerful tax advantage accounts in Canada, would you jump into a complex insurance-based strategy that's often less liquid, less flexible, and more expensive? Rule of thumb, build your foundation first, then consider alternative strategies. 2. Do I actually need permanent insurance? Whole life insurance is permanent, meaning it's meant to be kept for life. But not everyone needs lifelong coverage. If you're buying insurance just to borrow against it later, it's a very expensive loan structure. If your actual need for insurance is limited or temporary, ask yourself, would term insurance do the job? Is this about protecting family or creating a forced savings plan? How long until the policy builds cash value? Many infinite banking pitches show big borrowing potential in 5 to 7 years. What they often skip over is this. In the first few years, your cash value is very close to zero. You may pay tens of thousands of dollars in premiums before the policy becomes viable for borrowing. And if you need that money back in the short term, it's not easy to get. 4. What happens if I can't afford the premiums? Whole life policies aren't just set it and forget it. They require long-term premium payments. And stopping early can come with reduced benefits, surrender charges, lost capital if your income changes, or if you're not sure about committing for 10 to 20 plus years. This probably isn't the right tool. Is the advisor getting paid upfront? This isn't about questioning integrity. It's about understanding incentives. Most life insurance policies pay large upfront commissions to advisors, often thousands of dollars in the first year. That means there is a financial incentive to sell, whether or not it's the right fit for you. If an advisor is pushing infinite banking before understanding your financial plan, savings goals, and tax situation, walk away. There's nothing wrong with exploring creative strategies, but infinite banking is often sold as a magic solution when in reality, it's a very specific tool for a very specific person. If you haven't maxed out your TFSA or RSP, aren't in a high income or corporate tax position, or don't have a plan for your broader retirement income, then infinite banking probably isn't the right fit. At least not right now. If you've been pitched infinite banking, or you're trying to figure out whether it makes sense in your financial plan, don't go it alone. Click the link below to book a free consultation with me or my team. We'll walk you through a full analysis and help you make the smartest decision based on your goals, not someone else's sales pitch. Let me know in the comments, what have you heard about infinite banking so far? And what do you still have questions about?